Indian Army decimated terrorists who were targeting India using indigenous equipment. How can I invest in defense companies that create these equipment? Welcome to Bit of Nomics. If you were told there's a government-backed company in India that grew profits by 48% this year and could be your next multi-bagger, would you believe it? Today we will be analyzing one of India's most powerful defense PSU stock, Reach Shipbuilders and Engineers, also known as GRSE, and how it stacks up against other defense heavyweights. So, who is GRSE? And what does it do? GRSE has been around since 1884. They are a major Indian defense PSU, building and repairing ships for Navy and Coast Guard. It's India's first shipyard to build a warship for the Indian Navy. They've delivered over 100 warships and built everything from frigates and corvettes to survey vessels and patrol boats. Let's take a look at the financials now. For the financial year 24-25, the results are stunning. Its revenue from operations is Rs 5,076 crores. That's a massive 41% jump year-on-year. Hold on to your hats for the profit after tax. Rs 527 crores. That's a whopping 48% increase from last year. It also rolled out a dividend of Rs 13.85 per share against a face value of Rs 10 per share. One key thing to note here is 100 crore rupees of this profit boost came from smartly re-estimating their costs on the ongoing big projects. Now, let's take a look at profit after tax for last 3 years. The company has consistently been in profits, and the profits have grown considerably every year. But, is this growth sustainable? Let's check its health. GRSE is practically debt-free, with a debt-to-equity ratio of just 0.004. That's incredible for a manufacturing company. Their return on capital employed is great too, with 37.3%. That is lucrative for a manufacturing business. Okay, amazing performance, but what about the stock price? As of May 15, 2025, GRSE is trading around 2,258 rupees. This gives it a price to earnings ratio of around 49. 49 is on the higher side. It tells us investors are expecting big future growth. Its price to book ratio is also high at over 12. So, is this stock overvalued? Well, defense stocks often get a premium. The question is, can GRSE keep up the growth to justify it? Let's compare it with other defense companies to see how it is performing in its sector. GRSE beats most peers in profit growth and revenue growth. It is only behind Taneja Aero, whose market cap is 1/3 of that of GRSE. Madgaon Dock is larger, but GRSE is faster growing and more agile. Zen Technologies has higher return on capital employed, but is a much smaller, niche defense play. If you want both scale and growth, GRSE seems to hit that sweet spot. So, what's powering the GRSE growth engine? It has a massive order book. The management is confident about future performance thanks to a strong order pipeline. More ships mean more revenue. With government push for Atmanirbhar Bharat, more orders for Indian companies like GRSE. They're already exporting ships to countries like Mauritius, Guyana, and even have an order from Germany. With the recent triumph in war against terror, Indian-built defense tech is in demand. They're even looking at green ferries and new tech to develop new ventures. Every investment comes with its own set of risks and caveats. As mentioned earlier, the stock isn't cheap. If the growth slows, the price could correct. It is heavily reliant on government spending. Policy changes can impact them. Also, building warships is complex. It faces fierce competition from its competitors too. Looking at all these factors, risk seems to be high too. So, what's the verdict on GRSE? Is GRSE a buy for you? That depends on your risk appetite and investment horizon. This video is for educational purposes only. Please do your own research before making any financial decision. Let us know your thoughts about GRSE in the comments section. We hope you liked this video. If you want to view this type of content more, please like, share, and subscribe to this channel. Share with us your thoughts in the comment section.